Pre-retirement people, this isn't always the case, but a lot of times they're in higher tax brackets. And so the deductions are worth more. So I've had clients, Corey, that they really maxed out their donor advice fund right before they retired, anticipating that they were going to drop into a lower tax bracket, which
That's
is smart. And now what's really cool about these clients is that they've got a large pool of money that when they do want to donate to charity in retirement, they don't have to worry about tapping their retirement funds because they've literally set up an account outside of this. Now, you want to be careful with these donor advice funds, though, because they're irrevocable gifts.
right.
Once you put money in there, you can't pull it out for personal use. So you don't ever want to overfund these accounts. Like you can overfund your Roth IRA, you can overfund your IRA, you can overfund your brokerage account, and your kids or your heirs or whoever will get that money. It doesn't work that way. Now, you can set up a beneficiary on a donor advice fund, and I believe your kids or whoever you deem can then run the fund. This can be a charitable legacy account for your family, but you can't use it for yourself. So the last thing I want to see somebody do is overfund a donor advice fund, and they actually need that money to live off of.
Right.
That would be a problem. And luckily, I haven't run across that,
Sure.
and hopefully we never do. But so when you're doing this, don't go do it alone. You need to go look at your financial plan and figure out what makes sense. And then if it's $100,000 you're going to put in there, they can pull that out of your plan to see if your plan still works for all your other goals. So the key here is if you are working pre-retirement, front load those charitable contributions now while you're in a higher income bracket.